Welcome back. We're talking once again to Jack Lowenstein from the Morphic Global Opportunities Fund. Welcome, Jack. So how did January 2015 go, 1 month into the year?
It went pretty well. We were up about 4.5%, which meant we outperformed the market by about 1%. And from our point of view, because we're always looking for consistency of performance and steady grind away, if you like, of both absolute returns and alpha, it was our 4th consecutive month of outperformance. And that's the first time we've actually achieved that since we launched the fund 2.5 years ago, so we're pretty happy about that. The other thing I think we're very happy about is our approach to investing is to basically not lose money as much as possible, very obviously, but more importantly, we're really trying to generate returns for investors with exceptionally low volatility. And it was a month where we just steadily ground out the returns day by day.
And what in particular went well for you?
The best performing stocks in the portfolio were rather sort of in very different ways. A company called Axis Bank, which is one of the largest private banks in India, and on a completely different scale, a regional pharmacy chain in Japan called Kusuri no Aoki. Those two are our biggest returners, but we actually had the thing that really pleased us, we had very few losers over the month. We did very well with a company in Italy called DEA Capital, which is a funds manager where the company's buying back shares every day to the maximum allowed under Italian law. And as far as we can see, they'll be doing that for the next year or so, which is a very nice position to be in. They're buying back the shares below book value, which means every time they buy back shares, the book value increases. And we also did very well from our UK water utility positions, where the falling global yield environment meant more and more people were chasing what are relatively high dividend payers.
And those are individual stocks, but have you got some specific themes? Is it around dividend yield?
We do think that the world is now bracing itself to be stuck in a period of very low interest rates for a very long time. I think the biggest threat, to be honest, to the world is that nobody knows how central banks are going to actually manage to raise interest rates if they need to. But that environment means that people are chasing yield. How long that can go on for is to us unclear. We think the next phase is probably going to be that they start chasing growth. In a low growth environment, people will start paying a premium for any growth they can find.
And do you see any major risks around at the current time? Is it because of that incredibly low interest rates or low inflation?
I think that is a risk. We're not worried about deflation, but we are worried about low growth. There's obviously a considerable concern about the US being in a position where it feels it can raise rates from a domestic point of view, but is now looking at the rest of the world, which is not a very American thing to do, but they are currently doing it, and thinking, if we raise interest rates while the rest of the world's cutting them, how will that affect our own prospects? And of course, we saw in Australia in early February, the Reserve Bank cut interest rates slightly against the grain of expectation. And of course, everybody's now thinking, well, what does the Reserve Bank know that we don't know about how bad the Australian economy is going?
And are you negative on the Australian economy?
No, I'm not negative on the Australian economy. The Australian economy is performing quite well by global standards. It's not performing as well as it was. But what I am still very much a believer in is the Australian dollar will fall further from about the 78 cents level where it is as we speak to probably as low as the mid-60s. And the reason, and that may not happen overnight, but 75-ish is about the average of where the Australian dollar's been since it was floated under the Hawke Keating government. And so to come back from very high levels to this level of the high mid-70s is really only coming back to the average. Usually things like currencies tend to overshoot on the way down. And indeed, the trend is probably still looking a little worse for Australia. So our big concern is that most Australians are still very underinvested in global equities. And whether they invest in our funds or anybody else's, we would strongly be recommending they talk to their financial planners about whether they have the appropriate weighting in offshore equities.
And where are you expecting offshore equities to go? I mean, are you going to change any of your current themes?
Not particularly. I don't think we're still. We think we're in a low oil price environment. Maybe not falling any further. Maybe even bouncing around at these levels, but relatively low compared to where it's been. That's going to be positive for growth economies which have a dependency on oil, particularly like India. The big worry we have at the moment is we've done so well with so many of our themes for the last 4 months. We're now obviously concerned that February might see a bit of short-term give back, but we don't see any particular reason to change those themes at this stage.
Well, certainly markets have been incredibly strong on the back of those interest rates, so that can't last forever. I mean, it's obviously going to last for some time, but not forever. What happens when the music stops?
That's a very good question. I mean, I think the consequence of low interest rates has been a degree of asset price inflation. We see it most obviously in Australian house prices, but it's true to some extent about equity prices as well. And the concern is that if, for any reason, governments or central banks feel they have to raise interest rates, can they transmit that policy, and how will that affect any asset price bubbles that are built up? I think that's a couple of years away. My view at the moment is that for the next year or so, or certainly the next year, it's probably onwards and upwards, and the very, very easy money that's now available globally in Europe, Canada, Australia, Japan, everywhere really except and still the US, but perhaps not staying there forever in the US, is enough to keep on driving equity markets up for the next 6 months or so.
So more of the same.
I think it is, and I think as you rightly say, at some point it's going to get dangerous. Now, our investment style is to basically try and keep up in very strong rising markets and to really generate a huge amount of return, of relative return for our investors when markets fall. So the struggle for us, a struggle we're currently winning, is to try and stay up with the market or even a little ahead in those rising markets, but be very, very agilely prepared, or prepared to be agile, I should say, when markets do weaken. And the way we structure our portfolios is perhaps unique in the Australian environment for that ability to adapt very quickly if trends break and things start getting more ugly.
And that's through your macro hedges?
It's really more for our portfolio construction. The macro hedges are very important in terms of helping us weather the first blow of any downturn. But the fact that we have a portfolio construction model, which means that we can reduce our net exposure to the market much more quickly, I think, than most funds, really makes a big difference. Because we deliberately carry a lot of our exposure through futures and ETFs, which mean that we can actually cut our exposure very quickly without in any way losing focus on those individual stocks that we think will generate excellent outperformance.
All sounds good, Jack. We'll look forward to talking to you again in a month's time.
Thank you very much.
Thank you.